All right, now I deal a lot with older people. The majority of my clients are retired. I started my firm 35 years ago, so many of my clients have been with me for decades, and unfortunately, they're passing away now. And quite often, it's the husband that passes first. Well, what is the best way for a widow to use life insurance proceeds? Because if you have life insurance, I mean, it's a godsend for a lot of people. Now, there's a difference between young widows and old widows. I mean, there's totally different things. There's totally different ways you need to spend money on this case. But if you lose your spouse and you're retired, you're going to see at least usually a 40% decline in income. But most of your costs aren't going away. You know, you're still going to have the same cost to heat your house, maybe you have a little less food cost or, clothing costs and things like that. But for the most part, your expenses are not going to go down 40%. So that income hit, a lot of times, puts people into poverty, the widow. And thankfully, some people have life insurance that can offset that. So say you have a pension, you have a life pension, it stops when you die. Well, your wife's going to lose your pension, and she's going to lose part of the Social Security. Now, some pensions have a 50% option, but it's still a 50% reduction of your pension and a reduction of Social Security benefits. So it could be quite, it's bad enough to lose your spouse. It's one of the more stressful things in life that we ever deal with. And you don't want to have the financial stress at the same time. So life insurance is one of the first things that we should deal with after we've buried our loved one. Make sure you get as many death certificates as you can from the funeral director. It's usually available usually a week after a person passes and is buried. And I would say 15 is a good number. But it varies based on how many accounts a person has in their situation. And you want to claim your life insurance proceeds right away. Usually within a month, many times within a couple of weeks, those life insurance proceeds will be paid out to you. But you have to provide, obviously, a death certificate. So what do you do with that money? Well, first, maybe pay funeral costs. Funerals are very expensive. I mean, in this area here, you're talking $10,000 to $15,000 for a basic funeral. So if you don't have those extra funds laying around, the life insurance is going to pay it. Replacing income. Now, when someone has the option, they're retiring, and I have a large number of people now that are coming to me because they're facing retirement, either voluntarily or involuntarily, and they have options to take. And I talked about this in past shows, that you have to really evaluate these options because these are irrevocable. Once you pick these options, you're living with it for the rest of your life. And one of them that's very, very difficult for people is to determine how to take their pension. You take a lump sum maybe sometimes, or maybe you take your life-only pension. That's how you get the most per month. But if you die, it stops. Or you could take a survivor pension where you get less per month, but when you die, your wife gets half of it for the rest of her life. These are all different options, and sometimes there's as many as 10 options that a company will give you with their pension plan. And it's important to talk to, not a financial advisor, a certified financial planner, and I explained the difference at the beginning of the show, to crunch those numbers for you and figure out the best way for you to go. Now, one way I like to go is I like you to get the most money per month. So maybe with the savings that we're going to have with the extra income by taking the life-only pension, we could purchase a life insurance policy. So if you die and your pension dies with you, we have a whole lot of money to replace that income. So that's one thing you could use with life insurance proceeds. And many of my widows do that. They invest it and they take income from it every month. And now we're able to not drop 40% in income prior to your spouse's death. One way to use life insurance proceeds. Or if you're in debt, last thing you want is debt service with 40% less income. So maybe the life insurance can pay off that car payment, those credit cards, or whatever else that you may have, lightening your burden. And it could be a combination of all this. Maybe there's enough money to pay off the debt. Maybe there's enough money to pay off the funeral. Another thing you use with part of it is to build an emergency fund. So when things come up, life happens to us at the worst possible time. We need 4 new tires. The water heater broke. The roof is going. Well, an emergency fund of maybe 6 months' living expenses is a good thing to have. Unless you have liquid investments that you could easily access. That's fine. But you want to have money that you could easily access. Now, if you're a young widow, there's a whole different issue here. Chances are, if you're a young widow, at some point, maybe not next year, but at some point you're going to remarry. So that income will be replaced at some time. But if you're a young widow, maybe you want to use some of that money to fund a college fund for your children. Maybe you want to use some of that money to pay off the mortgage or to pay off car payments. Paying off debt is always a good thing. Always a good thing. Now, the mortgage is the last debt I like to pay off because usually the interest is very low. It's spread over 30 years. It's not crushing. But the first thing you always want to pay, credit cards. Credit cards, credit cards, credit cards. I hate credit cards. It's amazing how much credit card debt there is in this country. Crushing credit card debt. And again, it comes back to Americans living beyond their means. You do their budget statement, you'll see their income does not cover their expenses, so credit cards make up the difference. But to use a financial physician analogy, credit cards are cancer to the financial body. It's the worst kind of debt you possibly can have. So using proceeds from insurance to pay off credit cards always makes sense. So young people are different. Like when you're a widow at 35, it's a little different than when you're a widow at 75. And almost 40% of widows are in poverty now in America. When if you look at all 65 and older couples, only about 10%. So again, once the husband passes on, it's dangerous, to the financial health of the surviving spouse.